Joe, we're looking ahead to 2026 right now. To the earnings growth, is that going to come from tech? Is that going to come from comm services? Is that where you need to put the money as we go into not only the last month of the year, but go into the new year?
So obviously the last several quarters, the overwhelming majority of earnings growth has been attributable to artificial intelligence and therefore communication service and technology names. But I also think you've seen strong earnings growth in other sectors as well. And as you turn the calendar into 2026, into a year which I believe is going to have elevated volatility and is really going to be about idiosyncratic stories. And it probably means when I say elevated volatility, I think you have to understand your positioning might be a little bit different in 2026. You might not be able to extend some of the leverage very comfortably that you were able to do in 24 and 25 in anticipation of what? The beginning of an easier Federal Reserve monetary policy cycle. I think at 2026 that probably sunsets at some point, even though we have further rate cuts in front of us. But I think you're seeing an awakening for the quality factor where momentum absolutely dominated it in 2025. I think over the last several weeks, the market's saying, yes, we want the quality of healthcare. And I think it's reflected in what we're just seeing today. Look at the list of 52-week highs. We've spent the majority of the show talking about technology, rightfully so, but there are other names today making 52-week highs in the financial sector, regional bank, Cincinnati Financial. GM, General Motors, is making a 52-week high as we speak. Las Vegas Sands, Medtronic, Monster, TJX, Prologis, Rollins in the industrial space. So there's other places you could go, other opportunities. I think that's an important theme in 2026. It's going to get harder in 26. I can't see how it can't. That doesn't mean it's a lower market. It's just going to get tougher.
I think you make an excellent point about how the dynamics are going to change in 26. So I just want to spend a minute on this. We've had a couple rate cuts by the Fed, looking now again like we're going to have one in December. In 2026, the thesis seems to be that we're going to have some sort of cyclical reacceleration. Productivity is going to come into play in a big way. GDP growth is going to stay healthy. The labor market might stay stable. If there is a reacceleration, to Joe's point, the rate cuts will stop at some point because they would just have to. And we've seen this movie before. So if there's a reacceleration, maybe it's driven by technology and the optimism and the spending around technology. But at some point, inflation starts to either come back a little bit or at least plateau, and the Fed has to stop, right? In that reacceleration, the sectors that tend to do well are not typically the high flyers and the growth sectors. You have to start thinking about some of the more value-centric names and the sectors that would benefit from cyclicality. So I think financials is still on that list, healthcare obviously on that list. You have to think about maybe even materials in some ways. And then add to that 2026 is a midterm election year, usually pretty tough for the market. So for looking at places to hide from volatility, again, things like maybe even consumer staples coming into play, healthcare again coming into play. So I think there will be a much different leadership picture in 26, and the market will start to set up for that at the end of 25.
That's a great point, because if 9 months from now we're talking about we need another rate cut, then you're not going to get the double-digit earnings growth that's expected right now for 26. That means there's a bigger problem in the economy, for sure, and that's going to affect earnings.
You know, Liz, to your point, by the way, Bank of America out with its 2026 outlook, 7,100 S&P price target is about a 4% higher move from where we are right now. Overweight staples. So a lot of people seeing it the way you're seeing it.